Okay, because what a lot of people had indicated is that the inflation had escaped into wages claims, had escaped into the services industry, and this was going to be more difficult for the Reserve Bank to dislodge and get it back to that 2 to 3% band.
And these numbers today, Ross, show that that's not the case. So both inflation in goods and services below 1% in the June quarter. So that's quite a significant deceleration in services inflation in particular, and much lower than expectations. So we're seeing now an economy that's slowing, inflation that has decelerated, wage growth is not out of control, inflation expectations are not out of control either. So that's the sort of environment where we think the RBA should keep interest rates on hold. But in terms of those parts of the economy where we are continuing to see price pressures, the big one there is housing. And again, that's on the supply side in terms of the challenge there. We're not building enough houses in order to see rental growth slow. And that's not something that interest rates will fix either. So an interesting picture for the next few quarters in particular.
Okay, but is that enough really to knock the inflation decline that we're seeing off its target? The Reserve Bank has said it's prepared to see inflation glide lower to 2 to 3% by some 2025, so long as they try at the same time to keep relatively full employment, they say.
Look, we think that is enough. If you look at the quarterly number in headline inflation and in the underlying sort of trimmed mean, and you annualize the quarterly June number, you get sort of somewhere between 3.5% to 4%, so much closer to the RBA's target band of 2 to 3% than the 6% kind of year on year. A lot of that, what's in that 6% number, is kind of old news. That's supply chain issues coming out of COVID. That's Ukraine war pushing up commodity prices. That's now washed through, and so we do see the headline number coming back down to the 2 to 3% band, gradually, as the RBA would be hoping. The problem, though, the sticky part we see is more on housing, as I mentioned, utilities, potentially some variability in energy prices. So that will be the challenging part of the inflation story from here, and that's more about productivity, competition, and construction of dwellings throughout Australia that will help to bring that down.
So does that scenario almost lead me to a Goldilocks conclusion that Australia, again, the lucky country, has avoided the deepest of the recessions, has avoided the very big interest rate rises that we've seen in other parts of the world, has avoided in many ways, if you like, the very significant and debilitating effects of very high inflation that you've seen in the UK, parts of Europe, and maybe even in the United States?
Look, I do think that is a reasonable expectation at this point. It is quite an optimistic view. The caveat I would put to that is that the RBA has increased interest rates by 400 basis points over just over a 12-month period. And we know the RBA has told us that interest rate increases take 12 to 18 months to work through. So we haven't seen the full effect of those interest rate increases on the economy yet. Added to that, we still have a significant number of people on fixed rate mortgages, I should say, switching across to variable. That's going to exacerbate that the impact of interest rates over the coming few months. Those interest rates that have already been hiked, the impact that they will have on the economy over the coming few months. And so we're watching that pretty closely in the potential that the RBA has gone too far too early. So that whilst inflation's come back down closer to target, growth will continue to be affected by higher interest rates.
The message almost seems to be, Stephen Smith, that the Reserve Bank has to do no more. Many thanks for your time on the program today.